that at the moment we're not, we've got some way to go towards, if we head towards a global recession, but you're not ruling that out, given it's changed quite dramatically. A year ago, trade wars won't have necessarily been mentioned in the equivalent sessions that we've had with you. Within the space of a year, we've moved to its... if you can just set your mind on the prospect of a disorderly Brexit, either at the end of October, end of January, and try and explain to us which of those dates, presumably, given what you've said already, by January, what should we be expecting in relation to the economic scene and a disorderly Brexit, and what does that mean for the UK? And are you saying that the central bank, the Bank of England, is for those eventualities, for a possible global... What people will want to know is whenever that comes, whether it comes around the same time or soon after, or even a year after, do we have the apparatus to be able to cope with a global recession, and what does it mean for the British people?
Yeah.
Can you try and explain?
Let me pick up a few of those points. First, I would characterize the global environment has become more difficult. It's less supportive for UK growth. That's absolutely clear. And that it faces some unique challenges, which are principally but not exclusively related to the ongoing trade war. It is a trade war. That possibility of spreading to other jurisdictions, including Europe and by extension the United Kingdom. So this is a less supportive backdrop than we've at any other point in the last 5 years. A less supportive backdrop than we've experienced since I've been here as governor, let's put it that way. The second thing is that we and the UK is one of the most open economies in the world, cannot be insulated by developments internationally. There's nothing that we can offset some of these effects, but we can insulate and fully protect the economy. And in fact, there's various ways to model a trade. If there is a deepening of the tariff actions and persistence of those, and if there is this effect on business confidence outside of the United Kingdom and therefore business investment, the potential hit to the UK affected major economies because we're not directly in the sights of this trade war, but we would probably have an impact on the order of 1 percentage point or a bit more than 1 percentage point. Text the impact on the
more than 1 percentage
or 1.25, 1.5 percentage points.
That's significant.
But it's significant. But to put it into context, the impact on the United States would be more than 3%. I mean, that's our modeling, and that's.
And does that factor in a no-deal Brexit?
That doesn't factor in a no-deal Brexit. So this is independent of that.
Right. So what's the combined impact?
Well, speaking from we do not have a forecast for no-deal Brexit. We only have the worst-case scenario, which is not what would happen in a no-deal Brexit. So I wouldn't want to mislead by adding the scenario to the trade war, because the probability of that trade war effect is probably a scenario of Brexit.
So it could be half of the 1%.
I'm not going to be pinned down on a specific number. The point of your question is that is the system ready to withstand both? The financial system, in our judgment, it is, because that's exactly what we've been stressing it to, and of course we've left an additional buffer of capital and liquidity. And I would remind that the major UK banks now have £1 trillion of liquidity on their balance sheets plus access to us. But the economic, there would be serious economic implications if both were to occur at the same time.
Yeah.
Yeah.
Okay, just, sorry, did anyone else want to add to...
On the world, I mean, it's easier right now to see risks to the downside, and they plainly exist, not least from trade. But let's also put into context, easing of monetary policy has already happened during the course of this year. You're back up to the tail end of last year, and most of the world were planning and financial markets were pricing a further tightening in policy. You fast forward to today, we've already seen, global yield curves, the US and the euro area, fall by a whole percentage point over that period. That provides extra stimulus to the system. Indeed, that is the reason why in our forecasts in August, we see the world bouncing back a little bit. Not at a stellar rate, but from around 3% this year up to middle 3% next year and the year after. Now that's not all one side. There are definitely the balance of risks for me would be the downside for the reasons the governor says. Equally, there is stimulus in the pipeline, the effects of which we'd expect to be registering around now and through this year.
Okay. So just going back to Brexit preparation, is there anything else that the bank still has to do before the 31st of October, including, of course, and also is there anything that the government needs to do as per legislation that's still outstanding? Now I'm thinking in particular the derivatives market and uncleared derivatives, and any recent developments you want to share with us, and data sharing. Perhaps government can start.
Why don't I start? I think first thing is to say is that between now and October 31st, we are engaged on daily contingency planning for Brexit interactions with major financial institutions. So we're tracking things, and there will be issues that, and because we're tracking on a daily basis, there will be issues that come up maybe with individual institutions from time to time. We'll be on top of and address. So we're not just sitting back and waiting for the date. The second is that, as you mentioned, there are some unresolved cross-border cleared derivatives. Is an example that it's really in the hands of the European authorities to address those, and specific national authorities, both in France and Germany, are the concentration. They're considered north of, in a notional, they're around 23 trillion of uncleared contracts that are affected. I can write back.
And how confident are you that there'll be agreement?
Well, it's not. It's within the responsibilities of those national authorities. There is legislation in place in jurisdictions that has to be applied in order, and then there's other ways to address it, which is to change the counterparties and move the error judgment. That will not be. There's not sufficient time to do all of that. And that gets to the third thing, which is moving clients from the UK to the European entities, and there's various progress on that. I want to, if I can just say legislation, though, because you raised it. The first is that, can I commend the committee's role in this? The Parliament has passed statutory instruments that are relevant to the financial sector, and so has put in place the framework. The consequence of that has been that we've authorized more than 400, one of the consequences, more than 400 entities to make sure that they can continue to serve UK and global clients out of the United Kingdom. So that's all the good news. A couple of issues that are still outstanding. One, you'll be well familiar with the so-called in-flight files bill, which financial, I'll get the precise name for it in a second, but it's effectively implementation of legislation bill. And this is things that have changed since the acquis was onshored. It's not urgent, but it's important because over time it will undermine some of the coherence of the legislation. So, and that will as you shift parliamentary sessions, when that will need to be reintroduced. That's the first thing I wanted to mention. The second thing is that the effect to state aid does have some potential relevance for some liquidity provision that the bank might provide. Extremely rare, but extraordinary circumstances, although we are in extraordinary circumstances. And so, all things being equal, a lane, when appropriate, would be preferred. I should, though, take the opportunity to reinforce that we have 300 billion of facilities up and running that are not affected by this, plus just received a capital injection by the Treasury this year. So we also have balance sheet capacity above and beyond that 300 billion.
And on data sharing, there was a report about the disruption to the UK 174 billion global data hub. Did you want to add anything?
Well, it's, I mean, the UK, as you know, has recognized the framework, the EU 27. That has not yet been reciprocated. And so companies, including, importantly, financial services institutions, are having to rely on so-called model clauses, legal fixes, temporary legal fixes, recognizing that under GDPR, which still applies, obviously, in the European Union, that if those fixes are not in place or are not real time, there are quite severe potential penalties. And of course, there are enormous costs to separating pools of data. So this is, I think, take the opportunity to say it's in the interest of both sides to have this resolved in an enduring way.
Is it likely to get resolved before the 34th?
It's a question for the government, but I have nothing that suggests that it will be resolved.
Massive disruption on data if we leave the European Union, have a disorderly Brexit, a no-deal Brexit by the end of October.
I think,
and also in relation to the uncleared derivative, 23 trillion.
on the derivative side, the issues develop after we leave, we do think it's in the interests of European Union first and foremost, but both sides, that a enduring fix is put in place there. With respect to data, I will see your financial institutions that they have been addressing with the second best solution these issues, which is to put in place model clauses, these legal fixes around sharing, and that in that regard there should not be disruption. It's an issue that could potentially come later if again, major.
If there isn't an agreement by the end of October.
Well, there is unlikely to be an agreement, and so the first best solution is an agreement. The second best solution is firms take some legal risk, these model clauses, which allows them to continue operate effectively
but on data,
as before.
they haven't.
No, on data they have been doing that on a individual firm basis, and the largest sophisticated institutions are in that position.
But others aren't.
But others, not everyone will be.
So
and it's also, if I may, it's not to give you a sentence, less a cliff edge issue at the core. The financial